Welcome to Investors Insight, where today's topic is taxes, oil, and technicals. A lot to cover today. Obviously, we're still following along with what's going on in the Middle East. So before I give an update on oil prices and oil prices from an investment standpoint, and before Ty talks about technicals, Trey, we've got a lot going on in the world right now. We're looking at tariffs, the Middle East conflict, but something that we are focused on as investment managers is the Senate rewriting the tax bill. This is going to be a big, important piece of the market for the rest of the year. Talk about that. Give us an update.
Yeah, thanks, Bobby. So last week, the Senate Finance Committee released our highly anticipated text of the big, beautiful bill, the new tax bill, and it's wildly different than the House bill. And this is very important for us to track for multiple reasons. One, it impacts the markets because it impacts corporations, corporate taxes, but also impacts our clients' personal finances. Rarely do events impact the markets and the people's financial plans so directly as this tax bill will, because it will change the tax rates. It will likely not change anything for this year. And so what's the rush? What's the hubbub? Because we have until the end of this year to pass it before next year's taxes go into effect. And the reason there's a rush is that it's not just passing taxes for 2026. It also is going to increase and extend the debt ceiling. And that's really where the timing is. You can see here, we've talked about this a few times this year on the vlogs. This chart shows the Treasury General Account. So back in January, the United States hit the debt ceiling. And what that means is we cannot borrow any more money, net new money. We can reissue debt. We cannot borrow any net new money. So how are we spending all the money the government's spending? Well, the government is spending down its savings account, which is called the general account. You can see that that's been trending down. And when that hits zero, that's when we really get into trouble in terms of how are we financing our ongoing operations. So that's the real deadline that the Senate and the House are dealing with. They've got to pass this bill because this bill has to increase the debt ceiling. And that's projected, as you can see here, around August. The Senate said they want to get it done by July 4th. That's fine, but really they've got until August, not the end of the year, not July 4th. So there's really not a lot of time. And the fact that the Senate's bill is so different than the House means that it's going to have to go back to the House, and it's going to be difficult to pass in the House. So we don't really have a ton of time to get this through, but there's a lot of details still need to be worked out. So something we're watching closely. The market's not paying that much attention to it right now, but as we get closer to that X date in August, it's become more and more important. The market's really going to start focusing on it at that point. So we're going to try and focus on it now.
Yeah, so the next couple of weeks, we are going to be really focused on the tax bill. It's super important, especially for the long-term impact of the market. So, and then next, in last week's vlog, I talked about how geopolitical events impact markets and how the oil embargo in 1973 was an outlier that negatively impacted the markets. And we had some viewers ask about oil specifically from an investment standpoint, since the price of oil has spiked since the conflict with Israel and Iran started. So let's first take a look at the current production levels. And as you can see in this first chart, U.S. oil production hit an all-time record in December of last year. And the production of the U.S. and OPEC nations have increased global inventories while we've seen sluggish demand growth in recent months. Next, let's look at the next chart that shows what break-even prices are for firms existing wells operating in different regions in the country. Keeping in mind that oil spiked to the mid-70s range last week, and the break-even cost ranges from $26 to $45, which is well below today's price. So on average, firms reported a break-even price of $41 per barrel on existing wells. And so in looking at this next chart that shows break-even prices for oil firms with new wells, the average price needed to profitably drill new wells shows the average price of $65 per barrel to turn a profit. So oil prices above $70 a barrel is profitable for new wells and definitely profitable for existing wells. So the question will remain, how long will prices remain elevated due to the conflict in the Middle East, and how high will prices go with an extended and escalating conflict? We'll keep you posted. Oil prices matter. It matters for the consumer as well. And so, Ty, the market's been kind of jumpy the past 2 weeks with the conflict in the Middle East. Give us an update on market technicals.
Yeah, I think it's important to kind of go back to the technical perspective for the market when you have these geopolitical events, because I think the first instinct for people is, sell first, ask questions later. And that's why we're here to evaluate everything. You did a great job last week of talking about, how geopolitical events don't necessarily have a huge impact on the market. And so we want to keep that in mind, that anything like this can affect our personal lives. It can affect the economy. It can affect a lot of things, but it affects the market, much more differently. If you're looking at the technicals here in this chart, we have the 200-day and the 50-day moving average with support for the S&P 500 around 5,700 and 5,800. So we have very good support there, which is not much lower than where we are now. So we're not expecting any kind of big sell-off. And these are the levels that if we were to breach those on the downside, then we would have to evaluate further and see, what kind of legs does a sell-off really have in this aspect. But until we reach those levels, we're kind of in a consolidation phase. The market is very strong since it came off April, the April lows, of course. And so if you look at this chart, we have the bull and bear ratio. What we're evaluating here is sentiment. So we want to have strong technicals, but we also don't want to be overbought or in this euphoric zone where everyone thinks just buy, ask questions later. That's kind of when you get in trouble. Typically, that zone is around when we have maybe 3.5 bulls to one bear. Bulls, of course, being people that want, think the market's going higher, and bears being the ones that think the market is going lower. Back in April, around Liberation Day, we actually had more bears than bulls. Not a surprise. We had a deep sell-off. You get oversold at that point, and then we've had this terrific bounce. But currently, we're only at 1.5 bulls to bear ratio. Again, the danger zone is more like 3.5. So we have a long way to go until there. So sentiment looks good. It's not overly bullish. Technicals look good. We have strong support, not much lower than here. So again, there's a lot of noise out there and a lot of news, but I would just keep in mind that the technicals are telling us the market is in a good shape.
Yeah, so obviously we're watching taxes and the tax cut bill very carefully here. We're watching the price of oil, and we like what we're seeing from a technical standpoint. So a lot to cover. If you have questions on anything we've discussed, please call us, email us. We love to hear from you. Have a great week. Thanks.